All right, guys, welcome back to the Independent Investor Channel. My name is Ryan. If you're a brand new investor out there, you might want to stick around to this. This is one of the most common questions that I get on what is the best ETF out there to buy. A couple of the most popular are SPY, which is State Street's S&P 500 ETF, and then my personal favorite, which is Vanguard's ETF. Ticker symbol is VOO. This is going to get a new investor that may know a lot about the stock market. It's going to get them that diversified exposure, pay a little stipend, a dividend, and it's going to give them exposure to just over 500 companies that are represented in the S&P. And you might be thinking, why don't I just go buy shares of Pfizer at $30 a share? These will trade anywhere from a couple $100 to $300 per share. And you really have to understand you're comparing apples to oranges if you're going through that level of deliberation, okay? You really have to understand the power of what one share of each of these respected ETFs mean for you. You're buying that instant diversification. These ETFs are built to track a major index, in this case the S&P 500. So it gets you that broad-based diversification right up front, and it'll pay you that little bit of a dividend, just over 2% on each of these respective products. But we're going to use a couple of tools that are my favorite in this video to cross-compare the two specific to the expense ratio and see how that will affect your money over time. And it's really going to help you, if you're a new investor, make an educated decision about what product may potentially work better for you. And it'll help you make a more educated decision when you're looking to get started in the stock market. So I'm going to kick you into the Online Trading Academy, and we're going to jump into the scenario. Thank you so much. All right, so the best way to compare two investment products is to use the expense calculator. It's made available through the Online Trading Academy. This is a free service. You guys just need to use the link in the description, and you guys can kick over here and play with this this tool. This is a compounding calculator, but it is a little bit different than most in that this allows you to account for the fee structure as you build out an investment scenario. So this scenario is going to be real simple. This is a typical scenario of starting with $1,000. We're going to push it out for 30 years, and this is just a baseline. So I'm just going to show you how these numbers shake out after this first scenario is ran. When we're looking to compare two of the most common and popular S&P 500 ETFs, we'll do $100 per month, fairly typical there, and then we'll assume a rate of return of 8% per year. The first expense is going to be for the VOO, which is Vanguard's S&P 500 ETF. That's 0.03%. The next one, just kind of as a benchmark, is a 1% fee. That's going to be extremely low for a managed portfolio. Just for comparison's sake, we threw that in the middle of the comparison. And then finally down here, we've got 0.09, which doesn't seem like a whole lot, but the real takeaway is to understand how these increase over time and how they impact the investments going forward. So this will represent State Street's SPY, which is the most popular S&P 500 ETF available on the marketplace. So I'll just, for the sake of comparison, call this scenario 1. So we've got our $1,000 starting amount, 30-year at $100 a month, 8% anticipated rate of return in the market. Here's the difference here. Fee structure, or fee column 1, is 0.03. That's Vanguard's VOO, and State Street's comparable SPY here, 0.09. Total contributed over 30 years is going to remain constant at $37,000. And really where this hits home is for those 19-year-old investors that are hitting me up and wondering what the best S&P 500 ETF really is. And this really isn't too glaring, but the difference here in scenario 1 is about $1,749 between fee structure 1 and fee column 3 here. So just to compare those two, not a whole lot of difference over the course of 30 years, just shy of $2,000. And, you know, for a lot of people, that could come down to preference. You're not going to see a whole lot of difference. I mean, that's 3 decades. That's almost a lifetime of investing. But for comparison's sake, we'll move on to scenario 2, and we'll see how this can change with increased contributions. I've had a few folks hit me up and ask me, you know, if they had $5,000, how would they invest that? It's really easy to kick in here and just enter that starting amount. So in scenario 2, I increased this starting amount. Let's say somebody really wants to take advantage of this market now, and they've got a nice 30-year investing time horizon. So they start with $5,000, and they've got a little bit more per month to add to this particular scenario. So we'll throw $400 in here just to demonstrate, for exercise purposes. The real point and intent of this is to compare the fee structure here, which is 0.03 in the VOO, and then finally 0.09, which is the SPY from State Street. So we'll kick in and see how these numbers shake out. All right, so scenario 2 here, we've hit the calculate button, and you guys can come in here and run these for yourself. This is really just a walkthrough and a grander introduction for you to come in here and utilize this tool in the way that I use it, and that's to compare investing products, especially when it comes down to the expense. And you're asking me, you know, what S&P 500 index fund is the best, Ryan. You can come in here and validate it for yourself. And the bottom line here, the difference between fee structure 1, which would be the SPY or the VOO, excuse me, is going to render 613,000, and then SPY is going to render 606,000. So you can see here just a slight reduction. We kept the 30-year time horizon the same, but we increased the initial starting amount just to see how these numbers would shake out. And interestingly enough, here over 30 years, this would be a difference over that time horizon of 30 years of $7,160. So a little bit more impactful. We can run these numbers to allow us to give ourselves a little bit better chance. I mean, the 0.03 and the 0.09 really don't hit home when we're looking to select our products. A lot of times somebody will just recommend the SPY because it's the most popular and it is the largest of the ETFs, which is all true. But until you come in here and shake out the numbers for yourself, it really doesn't prepare you to make an educated decision on at least the impact of the expense over time. So I'll kick you back and we'll run one last scenario here just for demonstration purposes. So in all fairness, I really want to capture all of the scenarios that have been thrown my way. And in this scenario, this will be the last scenario we run to see how these expenses are impacted by just changing the dynamic a little bit. We'll keep the starting amount the same at 5,000, but I want to increase the time horizon for our investors out there who are 19 years old and they've got really their entire lifetime to push them up to at least 59 and a half, which would be that maturity age on the Roth IRA to look back over all of these contributions and earnings that could be tax protected at that point in your life. We went ahead and increased this to a $600 a month. Now that's pretty aggressive, but I've got a lot of people that are hitting me up that are making that money, and this is just for demonstration. Certainly this can be adjusted. If you did have more of an investing time horizon, you could adjust these numbers as well to suit your own scenario. I just think for demonstration purposes, this is going to kind of drive home the point in always recognizing the impact of expense over the choices of investments that you make. Okay, so we'll kick in and check out this last scenario real quick. So in scenario 3, this will conclude our cross comparison of the VOO and the SPY. These are two of the most popular products VOO has a couple of characteristics about it that make it interesting in cross-comparing to the SPY. VOO has about 123 billion in assets under management, and the SPY has close to double that amount at 245 billion. They both represent a dividend yield that is meant to reflect the S&P 500's dividend yield. The SPY is 2.186, and the VOO is just slightly below that at 2.174. So I really didn't see a whole lot of difference there. But this is where it really becomes interesting, is if we look at these last two columns here, the VOO is going to be represented in fee structure 1 here at just over $2 million. And then fee structure 3 that we've built here is for SPY. And the difference between these two are a little bit more staggering in scenario 4, the difference being just over $33,000 of just expense, guys. This is money that you're not going to get back. So $33,141 there of extra expense just to own the SPY as opposed to the VOO. And for a lot of you guys, maybe that's not that big of a deal. Perhaps maybe it's aesthetics. Perhaps maybe you would prefer to have the larger and more established of the funds over time. SPY has been around for a lot longer than VOO, actually, in my research. But I did run a 5-year scenario. I'm going to kick you guys into M1 Finance real quick and use that tool to show you guys the performance of these. But I think the real takeaway here is to understand that if you started a little bit less in your life when you were 19, 20, 21 and just getting started in your investing career, but look to really increase that amount over time, the real takeaway from this video is to understand that the more you contribute, the more that expense ratio really starts to really stick out as impactful over your money over the longer term. So that's the real takeaway here in running this cross comparison. All right, guys, so I've dropped you into M1 Finance. I'm finding myself more often using M1 Finance as a cross-comparison tool. I'll build my own custom pies. This one is just made up of the S&P 500, so I can use the tabs up here and understand what a 5-year and 3-year and 1-year performance would look like. So I'll start with the SPY 5-year performance at 27.78, the 3-year performance here at 12.61, and then finally a 1-year performance at minus 8.21. That's obviously indicative of the market that we've had here lately. And just a few other cool things that you can do is if you click into this, you can check the prospectus on this. Really nothing outside of what I've already disclosed to you, the 2.186 dividend yield, which is reflective of the S&P 500, and then of course the expense ratio, which is really the focus of this video. So I'm going to drop you into VOO and we'll finally close out the video. So I've dropped you into VOO. This is Vanguard's S&P 500, and the 5-year performance here at 28.18 does edge out SPY fractionally, I might add, and probably not enough to justify going with one product or the other. The 3-year performance is kind of cool to check in here, 12.79. Which does actually beat out the SPY, which is 12.61 again, just by a hair, splitting hairs here when we're comparing these rates of return over the last 5 years anyway. And finally, the 1 year, it's performed a touch better, losing just a little bit less than the SPY. So I really think this is an awesome comparison tool. I encourage you guys to use the Trading Academy, use M1 Finance. I did run the numbers on IVV, which is the iShares comparable product to these two in comparison, and found that the IVV was really a good product as well at an expense of 0.04. And I would really put that probably number 2 behind Vanguard's VOO. But just some justification as to why we look to draw awareness to how good this product is, getting us good exposure to the large cap equities blend market in the S&P 500 for a lot of investors that are looking to get exposure to the market in a diversified manner. Pay you a little stipend and a dividend, and really doesn't require a whole lot other than just initiative to want to invest. So with that, guys, we'll close out the video. Great to have you into this cross comparison, and I really hope you learned something from it. Thanks a lot. All right, guys, so we've come back out of M1 Finance. I really hope you understood the purpose of this, the deep dive between the S&P 500 offerings. This video really did do a little bit deeper dive into SPY, which is State Street's ETF, and then Vanguard's ETF. There are other comparable products in there. I talked a little bit about the IVV, which is the iShares version. These are all great products. Very, very low expense ratio, comparatively speaking. It's really going to give what I insist upon for a new investor that's really just looking to get some exposure to the stock market without the necessity and the risk of single stock building, which requires a lot more research and a lot more effort on your part to make sure that you give yourself the best chance of success. I think a lot of people, as an introductory product, can start with a passive product like an ETF and then graduate to something a little bit better down the line. But this will be a product that you're going to buy for the long term. And the real takeaway in this video was the effect of fees over time, and how when you invest more, it really does impact and increase the impact of those fees over time in your portfolio. So guys, if it's your first time to the message, subscribe to the channel, leave your comments at the bottom of the video, and share this with any beginning investor out there that's looking to get some introductory information on some product awareness. Bring them onto the channel, man. We'll help them out. We'll get them started off on the right foot, which I contend is one of the most important things that a new investor can do. Thank you so much for tuning into the video, and good luck in your investment future.